Okay, let's dive right into this explainer and unlock the secret language that literally drives everything in our economy. I mean, we're talking about everything from your local college side hustle all the way up to those trillion-dollar global empires. So get ready because we're going to master the fascinating world of accounting and finance. Now, just take a second to think about the sheer scale of this question. How exactly does the market mathematically justify a mind-boggling $2.9 trillion valuation for a tech giant like Apple? Investors don't just guess, right? And they definitely don't rely on gut instinct. They rely on published financial data. And today, well, we're going to learn exactly how to read that data for ourselves. Section 1, the language of business, translating the numbers. So to really demystify these massive valuations, we first have to understand the two different dialects of this language. Basically, management accounting is your internal playbook. It's flexible, it's tailored, and it helps managers make those daily, on-the-fly operational decisions. But financial accounting, that's your public report card. This is how you prove to the outside world, like investors, creditors, and the government, how well you're actually doing. And because it's public, it relies on incredibly strict standardized rules, like GAAP, to ensure absolute fairness across the board. Section 2. Tracking the bottom line. The Stress Buster Sandbox. Okay, before we cackle the corporate giants, let's play in a microscale sandbox for a minute, just to master the core concepts. This equation is the ultimate foundation of all business finance. It's actually pretty simple when you break it down. Absolutely everything a company owns, its assets, must come from somewhere. It's either borrowed money, which are your liabilities, or invested money, which is owner's equity. Assets equal liabilities plus owner's equity. It's basically a giant scale, and it must always balance perfectly. To really see this in action, let's imagine you start a campus side hustle selling $10 Stress Buster play packs. Little care packages full of toys for stressed out students during finals. To fund this brilliant idea, you put in $200 of your own cash, and you somehow manage to convince your relatives to spot you a $400 loan. When we organize all of that into your opening balance sheet, the accounting equation literally comes to life. A balance sheet captures your exact financial position at one single, frozen moment in time. And look at how perfectly it balances out. Your $600 in cash assets on one side precisely matches your $400 liability to your relatives, plus your $200 in equity on the other. Now, let's fast forward a month. Let's say you've successfully sold 100 Stress Buster packs, and now we need to put together an income statement. Unlike the balance sheet, this actually tracks your performance over a period of time. So we take your $1,000 in sales revenue, subtract the $600 it actually costs to make the packs, and that leaves a $400 gross profit. Then we subtract your $300 in operating expenses, stuff like table rental and campus ads, and you're left with a very neat $100 net profit. Bam! That right there is your proverbial bottom line. Section 3. The magic break-even number, predicting the future. All right, so instead of just recording the past, let's use this data to predict the future. How many units do you actually need to sell just to avoid losing money? Well, we figure this out through break-even analysis. First, you identify your total fixed costs, like your rent and ads that don't fluctuate, which is $300. Next, you find your variable cost for materials, which is $6 per unit. You subtract that $6 from your $10 selling price, giving you a $4 contribution margin. Finally, you just divide your fixed costs by that margin. And boom, there is your magic number, 75. You must sell exactly 75 units just to cover your costs. If you sell 74, you're losing money. But anything you sell past that magic number of 75, that is pure profit. Let me tell you, knowing this threshold is absolutely vital for making any kind of business strategy work. Section 4, analyzing a tech giant, scaling up to billions. Okay, now let's pull off a massive zoom out. Because whether we're talking about a folding table selling stress balls on a college quad or Amazon's towering corporate headquarters in Seattle, the underlying mathematical foundation never actually changes. Sure, the scale shifts from hundreds of dollars to hundreds of billions, but the balance sheets and income statements, they follow the exact same logic. To evaluate these massive corporate giants, we use something called ratio analysis. Take Apple's 2021 current ratio, for example. This is a liquidity ratio that measures their ability to pay off short-term bills by simply dividing current assets by current liabilities. And they sit very comfortably at a 1.14. Basically, anything greater than a 1 means they have more than enough cash on hand to pay their immediate bills without breaking a sweat. Conversely, if we look at Apple's debt-to-equity ratio for that exact same year, it sits at 3.87. Now, this metric compares funds acquired from creditors against the funds invested by the owners. So a 3.87 tells us that Apple actually relies quite heavily on borrowed funds to finance their global operations. They're borrowing nearly 4 times what the owners have invested. Now, you might be thinking a 3.87 debt-to-equity ratio sounds a little alarming, right? But wait until you see the actual billions plugged into these formulas. Apple has this massive liquidity cushion. We're talking over $121 billion in current assets, which means their creditors are definitely not losing any sleep. Financial analysts use these ratios to prove a really important point. A high debt load isn't inherently bad, just as long as the cash flow is there to comfortably support it. Section 5. The financial manager's role. Balancing risk and return. So you might be wondering who actually orchestrates this massive high-stakes balancing act of debt and equity. Well, that massive responsibility falls on financial managers and venture capitalists, and sometimes they completely rewrite the rules of the game. For instance, serial entrepreneur Vicky Saunders noticed that less than 4% of venture capital actually goes to women. So in response, she launched CEO. It's this super innovative platform where women pool their money together to provide 0% interest loans to women-led businesses. It's a radical, community-based model that completely proves funding doesn't always have to come straight from Wall Street. But here's the thing, whether you're utilizing traditional corporate debt for some massive tech expansion or tapping into a radically generous community fund like CEO, financial management is really an art form. It's all about navigating the risk-return trade-off. The primary goal is always going to be maximizing the firm's value to its owners. And you do that by carefully investing in projects that yield the absolute highest returns for a level of risk you're actually comfortable with. And just like that, you've mastered the foundational language of business. We've traced the exact same principles from a little folding table on a college quad all the way up to the glittering boardrooms of Silicon Valley. You now have the actual tools to translate the numbers. So the only question left for you is how will you balance risk and return to fund your very own game-changing idea?